Hi, this is Greg. Welcome to the channel. On this video, I'm going to talk about what I see now as the biggest risk to the economy and also the biggest risk to the stock market. Okay, so there were a lot of economic numbers that came out in the last couple of weeks, and we're going to talk about that really briefly now and then talk about what we think the implications are to this new data that's come out. Okay, so I think the first thing and the most startling thing is that on an annualized basis in January, inflation as measured by the CPI came in at 7.5%. This is an astounding number. It's the largest number since 1982, and for most of us, it's among the highest levels we've ever seen in our lives, and for many of us, it is the highest level we've ever seen in our lives. What makes matters worse is the PPI, which is the Producer Price Index. That's the price of unfinished goods that occurred during the manufacturing process, came in at 9.7% annualized. That is absolutely amazing. The next measure that came in was retail sales, which is a measure of economic activity. That came in at an increase of 3.8%, which was in excess of the consensus, which was 2.1%. Now, of course, all of this is happening in the context of the Fed reversing policy and beginning to tighten monetary policy, or at least they're talking about tightening monetary policy. And many people are debating whether they're going to continue to be dovish and do things too slowly and not with enough intensity to break the back of inflation, or are they actually going to get to the point where they become more hawkish and actually do what is necessary to break the back of inflation. Keep in mind, they're still printing money and they're still buying securities, even though they're tapering. Now, another thing came out from the Fed minutes this week, which was interesting, and it seemed like they were focusing more on reducing their balance sheet than they had in the past. This spooked some market participants, but to me, it really didn't mean that much. So basically, what the Fed is doing is they're proposing to raise interest rates starting in March, and everyone's wondering and debating whether it's going to be 0.25%, 0.5%, 0.75%. Nobody really knows. A lot of people think the market's discounting 0.5%. Secondly, they will be reducing their balance sheet. And thirdly, they will be reducing the money printing and the bond buying. Now, how swiftly they do this will really determine how quickly the liquidity is taken out of the market. Currently, by current estimates, there's approximately $1 trillion of excess liquidity in the market, which has to be wrung out before you're going to make a real impact on either the stock market or the economy or inflation. Now, this leads me to what I think are some of the biggest risks, not only for the economy, but also for the stock market. And I want to talk about that in a minute. But first, I want to show you a clip of Mohamed El-Erian, who's one of my favorite market watchers. And take a look at this, and then I'll come back with comments.
My first big picture question on where we are with the markets is the extent to which now these rate hikes are priced in such that the majority of the risk to equities when rates go up is already removed.
I don't quite think we're there yet. We're getting closer to that point, but we're not there yet. The good news is that the marketplace is forcing the Fed to do two things. One, to recognize that we have an inflation issue, and second, to be open to moving faster on policies. What we don't know yet, Wilfred, and this is important, is a combination of rate hikes and QT and what that does to liquidity and what does that to market functioning. So we're getting closer to that point, but we're not there yet.
In terms of the way for people to play this, is it going back into some of those equities with the most solid sets of earnings and cash flows like those big cap tech names, or are they still at risk because their multiples are still a little bit of a premium to the rest of the market?
So what the market needs is a common theme, a unifying theme. That used to be liquidity. That's going away. That's what inflation does. It takes that theme away. Earnings is the best replacement. And that's why these earning releases are really important. So the hope is from a macro level that earnings can play that role. From the micro level, it's all about name selection. It really is. And you want a few things. You don't just want strong, resilient balance sheet. You also want pricing power. Pricing power is going to be really important over the next few months. And then you want relatively low sensitivity to labor shortages and to supply side chains. Now, when you solve it that way, some of the names you mentioned do dominate.
Mohamed, where do you think inflation is at the end of the year?
Sarah, I wish I had a good answer for you. I think we have two equal probability events. One is that inflation stays high, call it twice the level that the Fed wants, 4 to 5%. But equally likely is that the Fed overreacts and we end up with low inflation, but very low growth, if not a recession. These are equal probability events. That's why it's hard to answer that question. Now, there is a positive tail, which is you got some sort of productivity boom or something that helps the Fed catch up because it is way behind. And the left tail, the one thing we want to avoid at all costs is stagflation. So my answer to you is either we're going to be at 4% with a growing economy still, or we're going to be at 2 or below and near recession.
Okay, so Mohamed is basically saying that in terms of the market sell-off, in terms of the market's reaction to this change in Fed policy and to the reaction toward the rise in inflation, we're not quite there yet. And I think I agree with that. We're not quite there yet, but it raises a very interesting and important question. And that question is, will this rise in inflation and persistent inflation, combined with the Fed tightening monetary policy, will these actions slow down the economy to the extent that we will eventually get a recession? I think the jury's still out on that because we really don't know how aggressive they're going to be at removing this liquidity and raising interest rates. So far, Jerome Powell has been a bit of a pussy, if I can say that. They call it dove, I call it pussy. He really has not taken the steps required. He printed money for way too long. He was way too accommodative for way too long while the government continued to dole out money excessively, causing all this liquidity to go into the market and into the economy, causing all of the excesses, causing the dramatic increase in demand, and causing us to be where we are currently. So he's tremendously behind the curve. He has been for over a year. I've talked about that extensively on this channel. And now the question is, what is he going to do? Is he continue to be a pussy, basically, and dovish and afraid that he's going to tank the market and tank the economy? Or is he going to do what is necessary to get inflation back to 2% and possibly put us into a recession? I think the jury's still out on that, but I'm beginning to think that he's going to be really forced to do what he's supposed to do. And if I was a Fed chairman or sitting on the board right now, I would be freaking out because they are so far behind the curve. It's completely ridiculous. So the question is for us is, as market strategists and or investors, where do we want to be? And I've said on past videos, very recent videos in fact, that most people on the consensus are moving into defensive plays, dividend stocks, and other defensive plays like banks. And, I don't necessarily not recommend that because, no one really knows right here which way to go. And to be honest with you, you're not going to get hurt with dividend stocks. I love dividend stocks. So I think that's a great strategy regardless of what the economy does. But if you believe, and I'm beginning to go into this camp, that the economy is going to slow down because of the inflation pressures and because of the Fed draining liquidity and tightening monetary policy, where do you want to be? And my answer, as I've said on past videos, is I want to be in growth stocks. Not the ones that don't make money, not the ones that just went public a couple days ago and don't really have a real business and don't have any cash flow or money. I'm talking about the high quality, well-capitalized growth stocks, mostly in the tech sector. And some ideas here are basically Apple, right? Amazon, Microsoft, and Google. Okay, as 4 examples. There are many other examples, but I think when the shit hits the fan and we go into a recession, you're going to want to be in growth, not in defensive names. Having said that, I love dividend stocks, okay? So don't sell your dividend stocks. Dividend stocks are a great place to be when you put them into the DRIP program and you get the compound return. So that's what I wanted to talk about today. If you got value out of this, please subscribe, like, and hit the bell. I'd love to have you on board for future videos so you can be on board and hear my views and some of the great market prognosticators that I bring onto the channel. And until next time, take care. And for now, it's Greg out.